Hey, good morning, everyone. Marty Missouri here, 11/26/2021, day after Thanksgiving. Happy Thanksgiving again to all. Folks, I was not going to interrupt you on this holiday weekend, but I feel compelled because as I speak at you, the Dow is down 1,022 points, just under 3%. The S&P is down little over 2.25%. The same for the NASDAQ, and the Russell 2000, believe it or not, is up almost 5%, 4.9%, as I talk to you here this morning. Among the holdings in our core allocation, our carbon credits ETF is up 1.5%. Verizon is up 0.77%. Gold is up 0.5%. Treasury inflation protection securities are up about 1/3%. And healthcare was up earlier, but it's about break even, up 0.05% this morning. On the downside, we've got uranium miners, oil services, energy companies in general just getting beat anywhere from 5 to 8%. Banks are getting just demolished today, down 6%, and so on. So pretty dramatic, one day sell off. Our core portfolio overall, by the way, is down about 2% so far this morning. So not quite as much as the major stock market averages, but certainly enough to notice. And the culprit, according to the headlines, is this variant, COVID variant, that's showing up in South Africa that has the world very concerned. Now, from what I'm gathering so far, they really don't know that much about it, but what little they do know has them concerned about potential transmission rates, efficacy of treatments, vaccines, and so on. Several countries are already proposing travel restrictions from South Africa. So definitely has the market on edge this morning. Typically, holiday trading is low volume. Got a lot of traders out on vacation. So if a wave of selling comes in, there may not be much activity on the desks to buy that up if it otherwise would. But so we have, clearly a catalyst for a abrupt one-day sell-off. And folks, I have seen 2% declines multiple times, as you might imagine, in my 37-year career. So you look at them, you study them, you have other longer-term indicators that instruct you in terms of whether or not this is something that's actionable. And in the long-term context, of course, it's not. But it's good to understand it. These days, a lot of you I know, relative to the old days when nobody looked at their stuff. I know a lot of people look at their stuff because they can on a daily basis. And so I feel compelled to kind of give you my thoughts about what I see when I look at things on a daily basis. So know, though, that despite the fact that, we do have this news, that as I've been reporting herein of late, our assessment is that the market's kind of weak, kind of heavy. This chart right here is the one we work on here on the videos a lot. Let me just pull in the S&P 500 itself. Remember, we broke out of this bearish rising wedge. We had a 5% decline in September, which was the worst month since last March, and we're getting half of that in one day this morning. But we broke that upward trend line here, and then we haven't recaptured it. We've tested it and failed, and we're testing once again this morning the 50-day moving average. And so I've told you that when you look at that and the momentum indicators, which I'll show you here in a second, that, the market looks heavy. It looks susceptible to something on the downside. And of course, it's looked that way for quite some time as it continues to melt higher. Haven't looked at volume with you of late, but we do look at it each week. And this is the daily volume bars here for the S&P 500. The yellow line is the 10-day exponential moving average, right? So it smooths out that line a bit. And notice we've been looking at this for the last 2-3 years and noticing that when this moving average starts hitting and breaching this threshold, the market starts showing more volatility. And so what this means is that whatever the direction is, it's being met with pretty low conviction. Not a lot of people, as the market has been moving up in these last couple of years. Largely, it's been on low volume, right? Now, when the market fell apart, it was high volume. We definitely had conviction among the sellers. but not always. Here we had a good rally and good strong conviction among the buyers. Up here, though, it's been really waning, and it's been looking kind of like it did before, things fell apart back here, right before COVID hit. And then those divergences among the momentum indicators are still there. We have a sell signal here on the MACD, and we had that before today, folks. And, we have these bearish divergences, and we have that on the relative strength index as well. So again, a heavy looking market to me. Let me show you one more time. This one that's been troubling, that's been a red flag for us. It's the breadth rating using the advanced decline line for the NASDAQ Composite Index, which holds a lot of today's market leadership, right? The tech sector and so on. Notice how it was rolling over before the COVID lockdown, right? Notice how it was rolling over before this 23% decline back in here and so on. So this is something, as I said in an earlier post, this is a red flag. So folks, the stock market was looking more susceptible, to maybe a news event like the variant out of South Africa. And recall, I hinted the other day that we have a new indicator that we're developing called our Equity Market Conditions Index. And about 3 months ago, it was scoring a plus 33. Today, it's a minus 17. And we take into account the dollar, interest rates, Fed policy, fiscal policy, valuations, political risk, sector leadership, macro conditions, copper gold ratio, and so on, to get a feel for overall equity market conditions. And right now, as we score that, it's not horrible, but it's certainly in the red, which all it means is that the ice on an immediate basis is getting thin, so to speak. And I've been saying from just an overall risk standpoint that this ice has been very thin for quite some time. Doesn't mean it's going to break and it's going to be devastating. It just means that some of these setups look like they do before the market breaks, right? And folks, so that's why, we're doing things like hedging portfolios and so on. And I think I'd like to kind of show you what a stress test for us looks like. So this graph, this smile that you see right here, this is the estimated movement in the value of a portfolio that we manage. This institutional portfolio doesn't have any tax constraints. It's a nonprofit institution. There's no idiosyncratic, legacy positions that the client wants to hold, no affinity positions, so to speak, as Nick likes to call them. It's just a portfolio that we manage unconstrained. So we use this as our proxy. In the morning when I say our core portfolio is doing this, I'm actually looking at this portfolio. So when I ask our system to estimate what happens to the value as the S&P 500 moves, and I snipped away values and things here. I've got, of course, confidentiality to be concerned about, but this is fine. This shows you, again, the value of the S&P moving higher, moving lower. And this is the value of the portfolio moving with the value of the S&P. Hypothetically, estimatedly. So I'm not telling you this is the guarantee. I'm not telling you this is exactly how it's going to work. Could be better, could be worse. But it's what shows up when the system estimates based on the correlation of all the assets in the portfolio, the movement in the options hedges that we have on the portfolio, and so on. So right in here, right at the bottom, that's about a 30% decline in the S&P. And that's about a 12 or so, 11 to 13%, I believe, move in this particular portfolio. Now, last year, from February to March, when the S&P went down, the major averages were down like 35% on average, this portfolio gave up about 12% peak to trough. Our retirees, most of them had mid to high single digit declines. And so we really didn't feel much of that hit, which is why we were hedged at the time. This today is where a 35% decline would put the S&P 500, and that's right around 9-10% for this portfolio. Notice though, we're hedged to the point it actually estimates that if we had something like, the tech bubble burst, or the real estate bubble burst in 2008, we actually come close to breaking even because of the amount of hedging that we're doing. And this is an abrupt, big, strong sell-off, right? But it does show us that when we test the portfolio for volatility, we're liking what we're seeing, and we think we're hedging appropriately, given what we're seeing in terms of downside risk. So clients, that's how we sleep well at night. with the responsibility that you've given us. Yes, days like this, you're going to feel it. I mean, the S&P down, 2.5% and the core portfolio down 2. But if the S&P were down 32%, you would be seeing a much, much better circumstance. What we're trying to do here is make money where money can be made, to exploit where we see real opportunities existing. And as I've said recently, we do see emerging setups that we feel very good about and very bullish on going forward over the next few months and years. But in the meantime, we see a lot of downside risk in this market that we think we need to protect against. Using again my ice metaphor, this is when you want to do that for sure, in our estimation. Okay, and then just lastly, and I'll let you go. People have been calling Bitcoin digital gold. I hear that all the time. And a lot of people believe that gold's, kind of lackluster performance amid a real inflationary environment is because people are using Bitcoin instead to hedge against inflation and the potential for a weaker dollar, or however you want to explain that. Well, I just wanted to show this morning, doesn't seem to be working that way, right? This is just to give you kind of the immediate effect of today's sell-off. Here is Bitcoin's chart as of earlier this morning, and here's gold's chart. So if people are buying Bitcoin thinking that it's going to protect you against big, sell-offs and shocks to the market or to the economy, maybe it will, but today is any example. I think they're operating under a misconception. And I don't want to get into the weeds on cryptocurrency. I don't want to pretend to be an expert on it. I do have my concerns. Clients, we talk a lot about it in our client meetings. And I'm not making a call on crypto one way or the other right here. I'm just saying I don't want to call it digital gold and pretend that it has the kind of properties and kind of the defensive market qualities that gold has tended to have historically. So folks, it's going to be interesting. Again, we're in that good season for the market. Of course, December is typically, historically, a very good month for stocks. This could be, a sell-off that provides good entry for short-term traders. Time will tell. But if you have had really rough Decembers like in 2018, and the received excuse is because the Fed was threatening to tighten monetary policy more. Right now, we have a Fed that really is being compelled to tighten up a bit on monetary policy. And then we have this COVID news on top of that. So we have kind of a double whammy, maybe, but we also have a technical setup, as I've been illustrating, and was somewhat suspect as well. So folks, got a lot more content for you coming up. Been doing a lot of work on the setup. As I said, we see things emerging. We think the overall relationship between government and private debt relative to interest rates, relative to inflation, make for an interesting setup. And we do find at least one very strong historical analog that gives us some insight into what to expect from monetary policy going forward. And that gives us insight into where to allocate assets going forward. And that's what we're doing. And we like it, but we do see risks that we're going to need to mitigate, and we're going to have to be very patient as these things develop going forward. Thank you as always for watching and listening. Please enjoy the rest of your weekend. Talk to you again soon. Bye-bye.